Right. So today we're diving deep into the flow of capital from the Gulf Cooperation Council, the GCC, and tracking exactly where that money is going in the UK residential property market.
hmm We're looking at some fantastic research from Nomo, which analyzed recent right move data.
And the big headline, really, is that while London is still king, the real story is, well, it's the diversification happening across the UK.
Exactly. The mission here is to unpack the why. We're moving beyond that traditional picture
Yeah.
of investors just snapping up prime real estate in London.
Okay, let's unpack it then. So London is the anchor, we know that, but Scotland is now pulling in 19% of total GCC demand. That's almost 1 in 5 deals.
It is, and what's so fascinating is how strategic that demand is.
Hmm.
It's not just Glasgow and Edinburgh, which you might expect.
University cities, right. A classic driver for GCC families.
Precisely. But we're also seeing interest in more, surprising rural spots like South Lanarkshire.
So it's not just about education.
No, it suggests that while lifestyle is a hook, there's a really sophisticated search going on for unique, secure assets outside of that fiercely competitive London bubble.
And right on Scotland's heels, you've got the Northwest. 18% of demand. Now, this is where it gets really interesting for your classic buy-to-let investor.
Yeah.
Why the Northwest? I mean, if it was just about finding lower prices, you'd see interest spread out more evenly. What's so special about, say, Manchester and Liverpool?
It boils down to a very professional calculation. It's yield versus your entry price.
Okay.
These cities offer, well, much lower entry points than anywhere in the southeast, and that translates directly into very attractive average yields. We're talking in the range of 5 to 7%.
And that's what's driving the institutional style investor.
That's it. The stability and the long-term rental demand in cities like Manchester, Liverpool, but also Birmingham, Leeds, Sheffield. That's the real prize.
So with that focus on yield, are the purchases themselves changing? The data points to a shift in buyer behavior.
Absolutely. We saw a notable 5% drop in demand for new-build homes.
Which is a bit counterintuitive, isn't it? International buyers usually love a turnkey property.
They do. But they're being partly replaced by what we call the second stepper category.
Yeah.
So these are UK-based homeowners moving up the ladder. Investors see these properties as more stable, long-term assets.
And crucially, the investment structure itself is getting sharper. We're seeing this clear move toward limited company purchases for buy-to-let or BTL investors.
This is a huge insight. It really signals the professionalism of the capital flowing in.
So it's not just a hobby.
Not at all. When an investor uses a special purpose vehicle, an SPV, it tells you they're chasing tax efficiencies, limiting their personal liability, and, planning for the long term. This is portfolio management.
And let's quickly touch on who's driving this. The UAE is still the giant at 57%, Saudi Arabia at 16%, both pretty stable.
Yes, stable year on year. But there were some small strategic shifts. Qatar, for instance, increased its demand by 2%, up to 13%.
And Kuwait fell slightly.
It did, by 2% down to 8%.
Right.
It likely suggests slightly different sovereign wealth priorities rather than a big regional trend. Bahrain and Oman held steady.
Looking forward then, how are finance providers reacting? Nomo seems to have played a big part in 2025 by being, well, very flexible.
Extremely flexible, offering higher finance-to-value ratios, up to 75% in some cases, plus incentives like cashback and help with legal fees.
And that flexibility sets the stage for 2026.
It does. The prediction is that GCC demand will get a real boost from falling borrowing costs and just a better macroeconomic outlook. But, and this is a big but for those professional BTL investors,
Go on.
you have to consider that the first phase of the Renters' Rights Act is coming into effect. That's a crucial planning point.
So bringing it all together, the UK property market is fundamentally changing for GCC investors. It's moving beyond London into high-yield regions, and, critically, those deals are being structured in a much more professional way.
Exactly. And the final thought for you to explore is this. Given this rise of highly planned, limited company structures and the focus on long-term stability, how will the new regulations in the Renters' Rights Act specifically alter the planning and the financial deal structures that are becoming so dominant?
A critical question for every BTL investor out there. Until the next deep dive, stay curious.